Hello, everybody. Welcome to Friday. Another Talk Money with Tom show today. Very excited that you're all here watching. What we're trying to do is trying to help people have a more successful retirement. We're big believers that, the more people know, the more education they have about how to manage money, retirement planning, tax planning, all of these different types of things, the better they'll do, even if you have an advisor. So we're really hoping today that you can take home, one piece of information that you can apply to your retirement, whether it's you're currently retired or you're looking forward to retirement. A lot of these things still apply, and there's a lot of pieces that can make your retirement more comfortable, and I think that's important. So you can send in questions to this email address that you see here on the screen, asktom@talkmoneywithtom.com. Eason is here today again. He'll be moderating our questions. He'll ask the questions, and then obviously we'll be able to, go back and forth on those. You can also put the questions into the chat box, and then we answer a fair number of questions that came up during our strategy sessions with our clients that I think are important for everybody to know. So really enjoy this process. Again, if you want to continue to get access to this content, one of the things you can do is you can subscribe to the channel and then hit the little bell button. You'll get notified when we put out videos. We have 750 videos right now on the channel. So good start on our content creation here, and we continue to try to really improve on that. So send in your questions even right now. Send them in during the week if you want. Give us a chance to think about them, maybe get a better answer. But anyway, so that's really fun. Look forward to talking to you about that today. I like to start off every show, of course, with a summary about what I saw happening in the stock market this week. Of course, this is an amazing week altogether, as usual. We've got all these different things happening, but the biggest inputs that we saw this week really, of course, had to do with the Ukraine situation and the oil price increase that happened because of that. And then on Thursday, we got the inflation number that came out that was quite high. And so these are the things that the market is going to be grappling with going forward. And I'll give you some of my kind of opinions on what I see happening there as far as that goes. So the Ukraine situation is very interesting in that it's extremely difficult to kind of handicap that and figure out where it might be going and what might be happening next there. And really, the biggest impact that we see there immediately is, of course, the increase in the price of oil, and we've all seen increases of price of gas at the gas station. And the ongoing impacts have a lot probably to do more with what's going on with the sanctions in Russia. What types of situations will come from that? Will there be some surprises? Because sometimes when you shut down pieces and Russia maybe defaults on their bonds, you might have some surprises, some things that happen that we weren't expecting to happen. I would say those surprises are a little bit more mitigated here just because this conflict's been ongoing for some time here, and it's not an overnight surprise, but nonetheless, sometimes there's consequences to some of these things that we can't really see. So we'll have to watch for that and see what happens there. We did see something very interesting, I thought, this week on Wednesday. And I'll highlight Wednesday because I think it's important. Number one, Wednesday was up a lot. It was really good stock market. We ended up seeing, a big up day, and it was caused by the fact that the Ukraine president mentioned that, they're not as interested in joining NATO. So that was, something the market looked at as a possible, negotiating piece that might help with resolving the conflict there. And then we had the International Energy Agency talk about releasing some more barrels of oil, and then we had UAE talk about the possibility of increasing production of oil, and we saw the price of oil drop 11% on that day, and the market went up tremendously, and we saw some really big gains from growth stocks. And I think this is a really important clue to what's going to happen here as things do resolve themselves in Ukraine, and then eventually hopefully resolve themselves in the inflation arena. When people were running back into the market, they were buying these companies like Microsoft, which was up 4.6%. And if you looked at kind of I have a couple hundred different ETFs that I'm looking at on a daily basis. Most of the ones that were doing really well at that time were the growth-oriented ETFs. And I think that's an important thing to think about, where you want to be replaced, where you want to be placed when some of these things start to resolve themselves. And so that was a big key. I think that was interesting this week as far as that goes. But then the next day, Thursday, the inflation number came out. and it was 7.9% on inflation for this February versus last February. So big number, high inflation. And so obviously the next week is the Federal Reserve is meeting. So we'll have to wait and see what they have to say. I think that's important. And then what they end up doing in terms of raising rates. We're expecting a quarter point increase in March, would be the first increase we've had really since they started decreasing interest rates 2 years ago. And so that's kind of a big deal. We'll see how that plays out. But one thing to keep in mind with inflation, and this is just a point that I think is interesting right now. I'm reading a lot of articles about what happened when inflation happened in the past. Here's how the stock market reacted. Here's what happens to earnings. Here's what happened to, the overall economy and recessions and all those types of things. And every one of these articles is missing one massive component in that in those situations, there was no pandemic. So there was no reopening where demand was exceeding supply, and there was no trillions of dollars of money pumped into the economy to try to support the economy during this pandemic. And I think you can make some mistakes here by kind of correlating what's happening, with inflation from the 70s and 80s to what might happen this time. And again, I think if you're not careful here, inflation could resolve itself quicker than people think because supply chain can start to improve. Demand can start to drop down just because the stimulus starts to burn off. And even more importantly, actually, a lot of people don't realize this, but a lot of the demand is being focused on goods and not on services. And so because people aren't traveling as much and they're not going out to eat as much, not going to movies as much, what happens when people start to do all those things is the dollar gets spread out over more area of the economy, and that will probably bring down some of the inflationary pressure on the goods because that money is starting to go in some of these other areas here. Now, oil is a big issue. It's something to think about. We'll have to wait and see what happens there. So we got one piece of Ukraine flooding over into the inflationary story. But nonetheless, I think we have to be very careful with assuming that we're going to have a scenario like we had before, and we have to be very careful with reacting to that and going out and just basically, investing in these things that would have worked in the 70s and 80s. Because if inflation comes back down, I think to look at what happened on Wednesday, look at what moved, and I think that's where we want to be placed. I think that's important. The whole concept at this point is to try to create recovery. The S&P 500 is down about 11% year to date. The highest point that it hit back in late last year to the lowest point it hit in the morning of the invasion on the 24th of February, it was down 14.6%. Again, those are normal downturns. The average downturn without a recession is 15%, so very similar to what we've done so far. And so really we're just watching for recessionary issues. And right now we're not seeing enough of those. There's some possibilities. There's some things that could happen, but really want to invest in probabilities, which right now the probabilities that inflation would be that a recession would be pushed out just because the economy is doing well. So very interesting week altogether. I think things are okay. We did not get back down below the low that was established on February 24th. We'll have to see if that low holds for the year, or do we go down a little bit lower. I wouldn't be surprised to see us go lower. But we'll have to wait and see. I think obviously the biggest wild card is what's happening in Ukraine and what might continue to develop there as far as that goes. So we'll watch and see what goes on in the interim until there's some recessionary pressure. Again, I think this is a chance to rebalance on these dips, and we rebalanced on the 24th of January and the 24th of February for our IRA accounts. I think that worked out quite well, actually. And so, just something we'll keep watching for. So look forward to kind of seeing what's going to happen next week. This is a very interesting time to be studying what's happening in the market, just so we can all kind of learn what to do in the future. Okay, Ethan, good stuff. Look forward to answering some of the questions. What do we have for questions today?
So the first question is a tax one. With tax brackets changing in 2025, should I consider Roth conversion accelerating it, or should I keep kind of the same pace?
Yeah, okay. So essentially what's happening is the tax brackets that exist right now are designed to sunset in 2025, and they're going to go back to the tax brackets that we had for personal taxes before the 2017 tax law change, right? So that's the parameters. So theoretically, the tax laws could not change. The brackets could be extended. It would take a Congress, that's united to extend them. So I'm a little pessimistic on that fact. I think that they probably will go back up to the old brackets, but you never know. I mean, that's raising taxes, which some people don't want to do. So that'll be interesting. But the question is, should you be doing more of the Roth IRA conversions now that before 2025, because taxes are possibly lower than they will be? You could make an argument for that, although one of the things that I have seen in our work, we have a program that we use to go through and figure out the optimum tax bracket to fill. And so, you go to 10%, the 12%, the 22, 24, et cetera. Which one is the optimum bracket to fill? And the object is, if I have a certain amount of income and the bracket is above that, I can convert some money to fill in the rest of the money to fill in that bracket. And, I pay the taxes with that. When we do this, the program that we're using automatically assumes that the tax rates are going to go up in 2025. And so you do have to be a little bit careful there as far as that goes, because if it's an optimal bracket at the 22 that's going to turn to 25 in 2025, that could be something that doesn't matter that much as far as that goes. But I would push the envelope a bit within this time frame. If I was looking at my Roth conversions, for a variety of reasons, you get it for less, and you get a scenario where you're now getting tax-free growth sooner rather than later. So yeah, I actually think there will be some push here by people to do more Roth conversions as we get closer to 2025. I wouldn't be surprised. I'm not surprised that this question is coming up now, but I bet you we hear it more often.
Yeah, and so Roth conversion is usually when you don't have income coming in. So usually it's when you after retirement. And if you're not doing Roth conversions, I think that's a great time to start considering it. If you have a kind of like a very big, tax deferred 401k, and you don't really have any kind of tax free assets, it's probably good to try and diversify your funds into
Yeah.
different tax brackets or
Yeah.
tax.
Yeah, one thing that's interesting though, I mean, even if you are working, it depends on what you're making, right? So if we go through the process to figure out what the optimum bracket is for you, most of the times it's either 22 or 24, right? That's what we've seen most of the times. And so what you're trying to do is fill those brackets. So if you're a couple, and I believe the 24% bracket goes to about 370,000 this year. And so if you have less than 370,000, and by analysis, your optimum bracket is the 24% bracket, you might still be able to do some conversions even while you are working, as far as that goes too. So it really depends on your situation. It is sort of a custom look as far as that goes. Roth conversions are more complicated than you think, but they're really powerful to do. They can make a huge difference in somebody's retirement.
Yeah, and the one knock against Roth conversions is it's a brutal feeling when you have to pay the tax bill though for it. When you even though an IRA, when you look at an IRA, always a portion of it's the government, but it still feels like it's all yours.
Yeah, exactly. No, I think that's a really good point. I think is probably the biggest sticking point we have with clients is the actual, so it makes logistical sense. We show them that they're going to have a higher net worth theoretically if they do conversions. But then when they look at, okay, what they're going to have to pay in tax on that conversion, and ideally you're paying that tax with money from someplace else. You're not withholding it from that conversion because that allows you to basically increase the value of your retirement account. So just so that's clear, if I have $100,000 in an IRA, I might only have 75,000 that's mine and 25,000 that's the government's, because once I pull it out, they take that tax. But if I convert that $100,000 IRA to a Roth, right, and I take $25,000 from my taxable accounts and pay that, now I have 100,000 in a Roth that's now worth 100,000. So to me, that's super powerful. I just added $25,000 to my retirement plans, and now it's growing tax free. But to answer your point, I think one of the things that really has to be considered here and that people don't realize is that although it's painful right now to pay these taxes, somebody's going to pay the taxes on that account somehow, some way. Tax rates are very low right now. And although it's painful, it's better to pay them when they're low. And because the other problem is your retirement plans are going to continue to grow, hopefully. 72, you're going to have to take money out. By age 85, you might find that you have a tremendous amount of money you're having to take out. And then you're really in pain. You can't get out of that because now you're in top tax brackets and you've got a situation where you're paying 3, 5 times more for Medicare. You cannot get out of that situation because there's no ability to convert within a lower tax bracket because you require minimum distribution. So I think what's happening there when people are worried about not about the taxes and the tax bite, they can't see the whole picture. We're dealing with the 85-year-old. We're dealing with the 75-year-olds that are currently paying more for Medicare just because they require minimum distributions. We're dealing with these situations where we had two earners, two 401ks, one person dies. Now it's all focused into one person's IRA. That RMD is focused around that one person, but they're now in the single tax filing situation, right? So they're having to file single head of household situation. Their taxes are much, much higher. And they really, even within the Medicare, so it's two people's money originally combined into one person. And now they're getting hammered on the taxes and you're stuck. And I've got clients like that. And it's why it was what made me convert all of my assets, last year at 2020 and 2021 because I've seen what happens. And I think if everybody truly understood what the future was for them with their IRAs, they would be much more interested in paying those taxes, even though it is painful. One caveat, it really makes a bigger difference if you have more in this area. You got $50,000 in an IRA. It's not going to make a big difference because the minimum withdrawal isn't going to be that high. You get $1 million to $5 million in IRA, which is what we're seeing, all the time here in the Valley. Boy, you're talking about tax time bomb. It is unbelievable. And if you could really understand it, you would happily pay those taxes now, especially since they're lower. The rates are lower as far as that goes. So, and doing it sooner than later allows it to grow tax free for longer, right? That's a big deal too. So anyway, it's very fascinating.
So our next question is, what is a backdoor Roth and what are the steps to do it? I can grab this question.
Okay.
So a backdoor Roth is the idea is that you have an IRA account and it's an empty IRA account and you add non-deductible funds into it. And then at a later time, you then convert it into a Roth. And so it's kind of like you do these multiple steps and you can, in a sense, backdoor it. And it's a kind of a gray area of doing this. You will also hear things about a mega backdoor Roth, which is doing after-tax contributions to a 401k and then doing a similar kind of conversion. Mega backdoor is a little bit more troublesome because your company has to be able to do it. You have to be able to do in-plan distributions. Depending on how your company accounts for the 401k, you may have a portion of it being taxable. So you have to check with your company. But for a backdoor Roth is you want to have no money in IRAs currently. So if you have monies in IRAs, one way to get rid of it is either convert it or you can transfer it into your 401k. And so you kind of need to start with a blank slate. Otherwise, you're going to be paying taxes because there's this coffee and cream principle. And so that principle means that you have to combine all the assets into one kind of block. And then you can't just pick and choose what assets you're taking out and converting. And so that would be the first step. And then after that, you would invest it and you'd wait a year. If you're more aggressive, some people say one statement, but usually you have to do this kind of a step transaction. Because if the IRS sees that you put money into an IRA and then you convert it instantly, they're thinking this is considered one transaction. And so you have to make it so it seems like multiple transactions. And so that's why there's this 1 year rule. And so you're in that 1 year, you want to invest it and you'll have some gains, but you're only going to pay on the gains. You're not going to pay on that whatever amount that you contribute after tax. And so that would be funneled into your Roth IRA. And then over time, you just keep repeating these steps. So, after you've converted, the next year you would wait a couple weeks and then you add more money to your IRA again. And then you'd wait another year to do the Roth conversion. And so you keep doing this. And one thing is never put a note that you're talking about this. It's kind of this gray area. And so you don't want anything written to talk about that.
Yeah, we've been asked several times about backdoor Roths. Around this time of the year that comes up, where clients will come in and say, "Oh, I've heard about a backdoor Roth. I want to do backdoor Roth." And really, what breaks it down almost every single time is that they have $300 or $500,000 in an existing IRA, and so if they put $7,000 with the catch-up basis, into that IRA, they can't move that exact 7,000 out, so they can only take a proportional bit, and so some of it's going to be taxable. It's a mess. So you're right. I mean, the big issue is having no IRA, and we don't see that very often. Honestly, people generally have it, although it does happen with somebody that has everything in their 401k. They can do a backdoor Roth that way. So anyway, it's a really interesting area altogether. Yeah, it gets asked about a fair amount. It's a little bit hard to execute.
Yeah, and it's weird because it's a bit of a gray area. So like you never know when the IRS is going to decide times are changing and we're not going to allow this anymore.
Yeah,
So
yeah,
so you have to be always wary of that.
yeah, yeah. That's right. It's fairly small dollar amounts too for what we're dealing with. You're capped at $6,000 to $7,000 a year in that backdoor Roth, mega backdoor Roth. A different thing. That's really too 401k can be a lot more money, but just the backdoor Roth is just dealing with an IRA. It's somewhat limited into what you can actually do with it too, but definitely worth looking at if you're in the right situation.
Yeah, and you this is always when you've exhausted all your other methods, right?
Mm-hmm.
So like say I make too much money to contribute to a Roth IRA, I already maxed my 401k. I don't have a Roth 401k. So this is where you kind of have to think about it. Now I'm starting to get into the more complex and kind of more niche
Yeah,
conversions.
yeah, yep, that makes sense.
So our next question is, how much money do I need to pull from my retirement accounts to live comfortably? This is a bit of a loaded question, but we can try our best to answer it.
Yeah, that's an interesting question. How much money do I need to pull from my retirement accounts to retire comfortably? Well, the first thing I would think about there is what do you need in dollars to retire comfortably? That is somewhat a question that has to be answered by you because that is quite different. I mean, we've got clients that live off of 50,000 quite comfortably, and other clients that are living off of 500,000. So it depends on who you ask as to what dollar amount you need. Um, Generally speaking, we actually go the other direction. We try to determine what that dollar amount is that makes somebody comfortable by going through a process and what have you. And then we see, is that possible within the parameters of what other income sources they have, what assets they have, and, if they're withdrawing this amount of money, how is that going to work? And of course, we use the Monte Carlo simulation to determine that. And because you can answer that kind of going backwards the other way and say, well, yeah, you need 70,000 to live off of or whatever it is, but if we put 70 in there, it doesn't work. Maybe 55 works. What do you think? Can you live off of that or not? Right? And so, and again, all these numbers are different for everybody as far as that goes. But that question I would probably answer the other way, just in the sense of figuring out what you could withdraw. Is that enough to accomplish what you're trying to accomplish? All right, that makes sense.
Like one brutally simple way it's just kind of like a generalization is you could take whatever expenses you have, a yearly expense, and then you kind of take that and then you multiply it by 25. And so in a sense, that's how much nest egg you would need in a sense.
Yeah.
It's like you get a 4% withdrawal rate, and that's
right.
a really rough way that you could estimate it.
Right.
Because most people tend to keep the same amount of expenses when they hit retirement
Yeah.
versus when they're working.
Yeah, well, that's what we've seen. Lifestyle is very difficult to change. So we've seen people, kind of continue along with that same path. And yeah, the 4% rule has been knocked around quite a bit, but it's not a bad place to start. You still want to, verify everything with the Monte Carlo simulation inside of a retirement plan, much more sophisticated analysis before you pull the plug and retire. But it does give you some ideas, of where you want to go in a simple term. Yeah.
Yeah, and a lot of people say in retirement you spend less money, but a lot of times is we shift our time and our time goes to a little bit more expensive, maybe
Right.
some more expensive hobbies. Like maybe I'm fixing up, restoring a car
Right.
and I'm putting way more time into that. And now that
Right.
becomes a bigger expense than it
Yeah.
was before.
Travel, that's a big one. We see travel expense go up. There's some expenses that go down, clothing, gas, car maintenance, some of those things, back when we used to actually drive to work or go to work. Uh, we'll see if that comes back. But, honestly, most of the times we see similar lifestyle. The one thing that people do save in a way is the fact that they're not saving. So if they were putting away 20, 30,000 a year to get ready for retirement, they weren't living off of that before. So it's really that net, after savings that they probably still need. And so, yeah, it's pretty straightforward from that point.
So our next question is, why is fixed income, like a pension or social security so powerful in retirement?
Yeah, it reminds me of situations that I've been in where, you know, I will be meeting with clients. For example, a couple, both were teachers, both put in their 30 years or what have you. They've got this kind of 80 to 85% of their income that they used to have teaching now coming in from their state teachers retirement system stirs. I remember in 2008, the market's falling apart. A lot of clients are coming in pretty concerned, because it was a big downturn. And got this teacher client couple sitting there. They're just totally relaxed, really, not worried about it. They haven't taken anything from their investments forever because they're basically able to live off of this pension that's coming in. And, it really drove home to me, uh, that's you want to, if possible, have some component of that. Now, Social Security is like that. It's a pension, and all these pensions are going to have some difficulties possibly keeping up with what you have for inflation for the things that you're buying. But it's still a really powerful component. It's just you've got money coming in from an outside source that is guaranteed, right? As long as it doesn't fail for some reason, which it hasn't. And you don't have to rely upon the stock and bond market as much. So if I need $100,000 and I've got, 100,000 coming from pension and Social Security, whatever happens to the market, I'm not that concerned with because I'm not using it. If I need, 100,000 and I only have $10,000 coming in from Social Security, for example, then I'm in a different situation. Now I'm withdrawing an awful lot of money out of the market and I'm hoping for good returns. And when bad returns come, it increases my stress level, right? So that's where you see this pension Social Security component really kind of add to the stress-free lifestyle as far as that goes. So not everybody has that. Not everybody can do that. Not everybody wants to be a teacher or a civil servant or fireman or whatever it is that creates these big pensions nowadays. But that's why it's such a critical component, though.
Yeah, the one caveat with pensions is a lot of times they don't keep up with inflation.
Mm-hmm.
And so that's why you kind of want a bit of both. You don't want to be purely pension
Mm-hmm.
or purely investments. You
Yep.
want to have kind of that diversity of income.
Yep.
And so your investments would outpace inflation. But then if the market's down, you want that rely on that pension that's
Right.
kind of there, that's kind of always coming in.
Yeah. Yeah. No, it's a great situation to be in for retirement, that's for sure. Like saying there used to be a lot more pensions in private business. Also, those have all disappeared for all intents and purposes. And so pensions are a little bit harder to get now. You have to take on certain types of jobs to get them. Social Security is still there, and maximizing Social Security, which is a big thing we work on all the time, is a really good idea. There's some great stuff that you can do to try to really bring that up as much as possible, and that does help, right? So almost everybody has Social Security if you don't have a pension. So that's an important component.
So this next question is more kind of like um, pertaining to the Russian Ukraine system
Mhm.
situation. Do you see any kind of contagion that can emerge from like this event or the kind of this conflict?
Yeah, so in 1998, Russia was struggling and they defaulted on their treasury, which was an incredible event, in my opinion. I didn't know that they were going to do that, and nobody else did either. And we ended up finding out about a situation that was quite, dangerous at the time. There was a company called Long Term Capital Management. That was headed up by a bunch of Nobel Prize winners, and they discovered kind of a way to leverage certain assets and find certain, uh, disparities between assets, and they called it a giant nickel sucking machine. So they used huge leverage to find very small things and turn them into good rates of return. And they were doing quite well. But they had a massive leverage position against Russian treasury debt, which failed, of course. And so then the leverage was still owed, and they were folding, and they did fold. But in so doing, if things weren't handled correctly, it might have brought down big chunks of the financial system. So one of the things that happened was that Alan Greenspan, this is the first time I've ever heard of this, ended up meeting directly with that company, and they bailed the company out. A bunch of different brokerage firms came in and put in the money, and they bailed out this big leverage position just to save kind of the overall markets as far as that goes. Um, Another kind of example, not Russian related, but it really is the 2008 downturn. So housing prices were going up a lot. People were writing these mortgages to people that really couldn't afford it, and packaging those mortgages together into bonds and selling them worldwide, get more money back, could sell more bonds. And then somebody in their infinite wisdom decided we could make money by insuring those bonds. So they're, supposedly AAA rated because they're mortgage bonds, and we're going to put an insurance policy on top and charge, and basically, charge $1,000 a year or whatever it was for those. Well, they all had to pay off because what we didn't know is that those insurance policies are called credit default swaps. They were sitting on top of these bonds. So it was a huge market. It was private. So when the Federal Reserve and the Treasury decided to let Lehman fail instead of bailing it out, it was going to be a $150 billion bailout. It created a house of cards that just came in because these credit default swaps had to pay off, and the companies had to sell everything, their stocks, their IBM, their Cisco, gold, whatever it was, they had to sell to pay these off. And so that's what's always out there, is this possibility of contagion that could sit on top of things. So we sanction Russia. There, I would be not surprised at all if they don't default on their bonds again. I don't know how they could possibly pay them the way things are going, and how strong the sanctions are, how many companies have left the country, and they're just continuing to tighten and tighten and tighten those sanctions. We're now, as a country here, we're not taking on Russian oil and gas. You got Europe talking about trying to reduce by 2/3 over the next 2 or 3 months their reliance upon Russian oil and gas. Boy, I don't know where that money's going to come from to pay their treasury debt or any of these debts, to be honest, even corporate debt inside of Russia that might be held by foreign, owners. So there has been big losses already. I read an article today. BlackRock had BlackRock, which is they own iShares, for example. They had exposure to Russia and different, they have a Russian ETF and different things along those lines. They had a $17 billion that just disappeared. Basically, the Russian ETF went from $600 million under management down to $1 million under management. So somebody lost money. It wasn't us. We luckily we don't have that kind of investments in our portfolio. And so, what are the ramifications for these different things that are going to happen? We've done the sanctions. What's the earthquake that could come through Europe or through other situations? These are things we don't know. The Federal Reserve didn't know that Lehman Brothers, by letting them fail, would cause this house of cards, create really a $7 trillion hole that they could have fixed for 150 billion, possibly, that type of thing. So. It's something we watch for right now. It's what I'm watching for mostly is what type of things can spread from here. I would say that the biggest positive is that this is not an unknown situation. So the credit default swaps that were all sitting on top of those mortgages was relatively unknown. I mean, the Federal Reserve and Treasury didn't know how much there was there. The fact that Russia was going to default on their Treasury bonds in '98 was a surprise. It happened kind of an overnight situation. In hindsight, you can always see some things, but at the time it wasn't obvious. This situation has been brewing for quite some time, and now we're weeks into an invasion, we're weeks into sanctions. Hopefully, a lot of companies have been able to unwind situations. I also feel like we're in an environment right here where I feel personally that we're kind of in a bailout environment anyway. We didn't used to do bailouts like we do now, and so this money might pour out if there was some kind of situation that created a contagion, much like those brokerage firms came together and paid long-term capital management. I think different governments and central banks and such might come out of the woodwork here to try to take care of some problems that happen, just because this is a worldwide effort to try to stop this situation that's happening there. And so I think we're okay on that, but it's a good question. It's something to watch for, but it's a really interesting subject to me.
Yeah, and like I believe so I was reading somewhere it's I think firms outside of Russia have $120 billion of debt that Russians owe to them.
Yep.
Um, JP Morgan has 650 million. And so if there is a default, at least they know. I think it's a French bank that has 21 billion
Yep.
that's owed to them.
Yep.
So like there's some big banks that have a lot of money owed to them
Right.
that will take these hits
Right.
if Russia defaults.
Yeah, don't be surprised to see some type of money flowing their way. Again, this is a national, or international effort to try to deal with this, and we want to do these sanctions. We don't want to kill ourselves doing these sanctions. So, honestly, 21 billion is a lot of money, but I mean, we did trillions of dollars worth of stimulus bills and what have you that have come out. And so I wouldn't be surprised to see some bailout situations happening, especially if it's an extreme situation that could cause other problems. Again, if Lehman Brothers would have been bailed out for 150 billion, which is a lot of money, but it created the 2008 downturn, which is the second biggest downturn we've had. And really, they call it the Great Recession. It was very close to being another depression. And in hindsight, maybe it would have been worth bailing them out instead of what we ended up with all these big, stimulus things. It was the first time we did the TARP and all that kind of stuff that came out. Started sending people checks and such, which we did again during this pandemic. But so I wouldn't be surprised to see some of that taken care of in this environment, and really kind of controlling some of that possible contagion from spilling over into other parts of the markets. If that's true, if we can control the contagion, then the real issue is this situation with the oil and gas from Russia and what that does to the price of oil, how that impacts inflation, how that impacts the Federal Reserve's decisions on what to do about inflation. So that'll be a bigger impact. And I still feel like that can resolve itself too. They do produce 10% of the world's oil, but there are a lot of other producers that could make that up, just not right away. It'll take a while.
I think there's also you should consider the other commodities too.
Mm-hmm.
Wheat from Ukraine and Russia are
Mm-hmm.
massive export to Europe
Yep.
and
Yep.
Africa. Is there going to be food shortages or food
Yep. Yep.
price increases that will affect the rest of the world? And so it's
Yep.
important to realize that both these countries do produce a lot of commodities that go
Yep.
onto the market.
Yeah, 33% of the palladium that's used in semiconductors comes out of Russia. There's a neon gas that's used in semiconductor production that comes out of Ukraine. That they have a high percentage of the world's supply. So yeah, there are a bunch of pieces. The nickel has gone crazy, right? I mean, as a metal, and some of these things are definitely hitting some disruptions. And that will continue for a while as far as that goes. And so, what impact does that have? Another thing to be watching. It's a good point.
So this is a question on where should I put my money. Is I've maxed out my retirement accounts. Is there any way or creative ways to build more wealth for retirement?
Creative ways. I don't, as money managers, and dealing with clients' assets and dealing with, the basically somebody's mostly their whole net worth, their life savings. I wouldn't say we get too creative personally. Um, what we would look at there, so somebody has maxed out their contribution to 401ks and or IRAs or even backdoor Roths or any of those things that that are possible. Um, then you're left with really two big asset classes, tax free, which you can't really do if you're maximizing out. That'd be your Roths, and then taxable accounts. So that's what we would look at in a standard situation, is just starting to build up taxable accounts. We've talked about this many times on the show, but we're huge believers that of those three buckets, that's the one that tends to be the weakest. Is people's liquid assets that are outside of these retirement plans. Gives them plenty of flexibility, gives them ability to pay taxes on their Roth conversions, gets them a chance to live off of that taxable asset at a lower tax rate because they've already paid taxes on some of it, and the rest might be at long-term capital gains rates and all of these things. So if somebody's maxed out their retirement plan contributions, I'd really like to see some of that money going towards these taxable accounts. Just a regular brokerage account. You can buy anything you want with that. Just buy regular index funds, buy the S&P 500, whatever it is that you want to do. You can buy the total bond market index if you so desire. Put it in, money markets and savings, and making sure that you have enough emergency cash built up. So those are all things that I think are interesting. But when you say creative, there's a whole bunch of things that people are doing that are working quite well. It's not things we get involved with. Collectibles are one area that I have seen a lot within my clientele, whether it's coins, cars, or art. Those are seen to be the biggest ones, or even wine, actually. That's an area where we've seen some pretty big growth in the value of the bottles of wine somebody has. And unfortunately, I have yet to see any of those situations result in supporting a retirement. So people aren't selling a car every year to support their retirement because they love the car. That's why they have it. Maybe they're trading or doing different things, but they're still staying within that hobby. I don't see people, selling their wine bottles off to support their retirement. So it is something you would do, honestly, right? If everything fell apart, you'd sell some of your collectibles if you had to, pay your bills or put food on the table. I just haven't seen it, but there are a lot of different, creative ways of where you might put money.
Yeah, I think one thing we missed was real estate.
Mm-hmm.
That's one way people create wealth is just real estate. Maybe it's an investment property, a
Mm-hmm.
rental property,
Yeah.
or make an Airbnb,
Yep.
and that could be steady income that you can use in retirement.
Yeah, that's a good
Um,
point.
yeah, and a lot of the passion collections, it's hard. I think a lot of people collect it for that passion, and it's hard selling a piece of your collection. You
Mm-hmm.
become emotionally attached to it.
Yeah.
But I know some people, done really well in the sneaker game,
Yeah.
and they've sold and they've put down payments on houses in
Yeah.
like more lower cost of living areas because they've done so well with it.
Yeah, that's cool. Yeah, I mean, whatever it takes for housing as far as that goes. But that's a good point. Real estate would be one of the areas to definitely take a look at. We've had some clients that are unbelievably successful in their retirements, and they have an awful lot of money coming in from, their rental incomes. And so, you buy the right house in the right place, you're going to get a decent income from it, plus get some appreciation if it works out right. It can be hard to do because it usually takes a fair amount of capital to save up to get there, but it is something worth looking at. That's for sure. That's a good area. You're right. Um, Okay, good. That's the end of the show today. Really thank everybody for coming. Hopefully, everybody got at least one thing that they can use. Feel free to, subscribe to the channel, hit the, bell button, and if you'd like to book an appointment with us, feel free to do that. Also, we have a, book appointment button on our website. You can see a link to the website here, right on this channel. We can spend 30 minutes on the phone or on a video conference, just talking to you about, what we can do for you and to give you an idea of some, custom answers for you specifically. And so look forward to seeing you next week. And thank you for joining us this week. Thank you.